And Wall Street is reacting after the 9th consecutive interest rate increase by the Federal Reserve. The Fed raised its short-term borrowing rate another quarter point yesterday, intensifying the central bank's fight against inflation. But what does that mean for the banking industry and your money? Our chief business correspondent, Rebecca Jarvis, breaks down those numbers for us. Hi, Rebecca. How is the market reacting today, and what's the expected impact on the banking industry?
Well, Diane, what the market is doing right now with stocks higher at the open is that it's looking forward as opposed to backwards. And even though Fed Chair Powell hiked interest rates again yesterday, the 9th rate in the last year, and they've been aggressive about doing this to fight inflation, what he signaled in the comments yesterday is that instead of ongoing increases, which has been a factor of every rate hike up until yesterday, that it looks like those rate increases could be coming to an end. And that's what Wall Street is responding to. That is why stocks are higher. We've also seen a little more stability in the banking system from 2 weeks ago when SVB collapsed. Now you're seeing a lot more overall optimism about where the banking system will go from here because of those emergency measures by the Fed, the Treasury, and the FDIC to guarantee all the deposits at Signature Bank and SVB Bank for all the depositors. So in the end, no one lost any money, even in the midst of these bank failures, Diane.
Now, what does this quarter point increase mean for things like credit card rates, our mortgages, interest on savings accounts, things like that?
This is the hard part in the entire scheme of the Fed's rate hikes, because on the one hand, they're doing this to drive down prices. We're paying right now about $395 more every month on the same goods and services because of inflation as we were a year ago. At the same time, borrowing across the board costs more money. So if you look at credit cards, those have gone from about a 16% average APR to now a 20% average APR, and they will go up in the next 1 to 2 billing cycles, somewhere in the range of 20.29%, and those small increases in the rate end up as large increases on your credit card bill, especially if you're only making the minimum payments. You're also seeing that, Diane, in areas like mortgage rates, which we have now seen at last year around this time. You could have gotten a 30-year fixed rate mortgage for about 4%. Today, it's more like 7%. That's made a lot of people who own homes pull back on the idea about ever selling, or at least selling in this environment. So there just aren't a lot of homes for sale. That's kept prices relatively high. And then it's also been a big issue for people who are trying to pay with credit, which is so much more expensive now, Diane.
All right, Rebecca Jarvis from Wall Street for us. Thank you.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.